Started.
5 p.m. divided in food under the personal business contract. Okay,
Good day, everyone, and welcome to today's class. My name is Niyada Abdulwasiu, and today we are going to be talking about ledger. We'll be talking about bookkeeping and ledger accounting. Bookkeeping and ledger accounting. As you can see from your screen, we have what we call accounting cycle. And before that, let me make a brief recap of some of the things that we talked about in the previous class. In the previous class, we were able to talk about the introduction aspect to accounting. That is, what's the meaning of accounting? We're able to talk about that. Accounting is the process of collecting, is the process of classifying, is the process of summarizing and analyzing and interpreting financial data. We also talk about what are the classification of items in the financial statement. And we say that we have 5 elements in the financial statement. That is, item that you see in the financial statement, we can categorize them into 5. We have what we call asset, we have what we call liability, we have equity, we have expenses, and we also have income. So we're able to define what is liability, what is expenses, what is income, and the rest like that. Then we also talk about the users of accounting information. Who are the users of accounting information? We have many users. The government is a user. The tax authority is also a user. The customer is a user. The lender, the provider of finance, the potential investor, the shareholders, the management, the employee. They are the users of accounting information. Then we also talk about what are some of the characteristics of accounting information. What are the characteristics that accounting information is expected to show? We say that we have 2 characteristics. We have what we call the fundamental, and we also have what we call the enhancing. The fundamental characteristics of useful accounting information is further divided into 2. We have what we call the relevant and the faithful representation. We also talk about the enhancing. What are the enhancing characteristics of accounting information? We have timeliness, it's very, very important, understandability, comparability, and we also talk about variability. We talk about the introduction to regulatory framework in accounting. What's the role of International Financial Reporting Foundation? What's the role of the Financial Reporting Council in Nigeria? We also talk about accountant. That is, we have what we call accountant can be divided into 2. We have what we call accounting in members in practice, a member in public practice, and we also have what we call member not in public practice as well. And we also talk about different form of business organization, the sole proprietorship, the partnership, and the corporation. So today we are going to be talking about bookkeeping and ledger accounting. And as you can see from my screen, we have what we call accounting cycle. And the first process you can see is the source document. The first process is the source document. The second process is the journal. The third one is the ledger. Then we have a trial balance. Then we can now prepare our financial statement. Once we have the trial balance, we can prepare statement. So the first one is the source document. The source document is the building block. So anything that you want to do, if you want to prepare your financial statement, the starting point is from the source document. Like, for example, now, if you want to buy a certain item, the first thing that we have to do is to make a PO, to send a purchase order to the suppliers that, I want you to supply me this also particular item. So your PO, the delivery note, your credit note, your debit note, your purchase order, your sales order, those are source documents. So after source document, then we now have a journal. And journal is about what? It's about debiting a certain account and crediting what? Crediting another account, and including a what? A little narration to it as well. And we also have a ledger. And a ledger, once you understand the ledger, there's not a big deal in what's in journal. What we do in what we do in ledger is almost the same thing as what we do in what's in journal. But journal is not for what? Journal is not for recurrent stuff. Journal is for what? It's for certain item that does not have a ledger for it as of now. So, but today we'll be focusing on what? We'll be focusing on what? Ledger. And before we start now, what I want you to do is that, if you can remember, we talk about what? Accounting concept in the last class. You make mention of some accounting concept. And let me remind you of what we call what? The duality concept. And the duality concept said that for every debit, there must be a what? A corresponding what? Credit. For every debit, we must also have a what? A credit. So every transaction that occur now, if I debit certain account, I must also do what? I must also credit another one. Debit one, you also what? You also credit another one. And I also told you in the last class that every transaction that take place, we can categorize it into 5. We can categorize it into how many? We can categorize it into 5 based on the element of what? Based on the element of financial statements. And I told you that asset, we have 5, right? We have assets, we have liability, we have equity, we have income, and we also have what? Expenses. All right. So now you see asset and expenses, they have the same what? They have the same treatment. Asset and what? Asset and expenses have the same what? Asset and expenses have the same treatment. And I told you that if your asset is increasing, you are going to do what? You are going to debit. If asset account is what? Is increasing, you are going to do what? You are going to debit it. If your asset is increasing, if your expenses is increasing, you are going to do what? You are going to debit. And if your asset or your expenses is reducing, what are you going to do? You are going to do what? You are going to credit it. Does the opposite. If asset is increasing, you do what? Asset or expenses is increasing, you're going to do what? You debit. If they are reducing, you do what? You credit. So if your what? If your income, if your what? Your liability and your equity, the remaining 3, liability, equity, and what? Income. If they are increasing, what are you going to do? You are going to credit. You are going to credit. If your liability, your equity, or your income is increasing, you do what? You credit. Why? If they are reducing, what are you going to do? If they are reducing, you are going to debit it. So as you are what? As every transaction is what is taking place, what you just need to know is for you to be able to understand them. Oh, this particular account now, what happened? Am I buying, or are we buying something? Are we selling? So if you are buying, what are the account that we are going to debit? What are the account that we are going to what? What are the account that we are going to credit as well? So this is a what now? This is a ledger, as you can see. You are going to have the what? You are going to have the title of the what? You are going to have the title of the account. You are going to have the title of the what? You are going to have the title of the account. We'll have the what? We'll have the debit, and we also have the what? The credit side. We have the debit. So once you have something like this in T, it means this is a what? This is a what? This is a ledger. Ledger is divided into 2 fold. We have debit, and we also have what? We also have credit. Ledger accounting and division of what? Division of ledger. In most business what? Entity, each classes of transaction and their associated what? Asset and liability are given their own accounts. That is now in what? Ledger is what? We can have different type of what? We can have different type of ledger. We can have different type of what? Ledger, which we are going to be talking about today. For example, there may be a separate account for sales. There may be a separate account for purchase, the rent, the liability to pay your what? Your supplier, which is your what? Your payable. Amount due from what? From customer. When you say amount, the what? For a customer now. The ledger that we maintain for our customer is what we call what receivable account, trade receivable account. Please don't forget. Our customer, those individual, those organizations that is buying from our company, those our customer, we maintain a ledger called what trade receivable for them. So while we, the organization, now we also buy from what? We also buy from another party as well. We buy from individual, we buy from organization as well. So the account that we are going to maintain for those that the organization is buying from is what we call what? Payable. We call it what? Trade payable, what? Trade payable account. So those are the what? Those are the account that we are going to maintain for those that we are buying from them. We call it what? Trade payable account. But those that we are selling to, we are going to maintain an account. We are going to maintain a ledger called what? Trade receivable account. There's no rule as to how many account can entity should have, but the system should facilitate effective accounting and what? Control. Each accounting in the system is referred to what? A ledger. Each account in the system is referred to a what? A ledger. In simple terms, a ledger account are where double entry record of all transactions and events are what are made. That is, where do we record transaction? Where do we record transaction? We record transaction in what? In ledger. Don't forget. We record accounting transaction in what? In ledger. They are the principal book or files for recording and totaling what? Monetary transaction by what? By accounts. An entity financial statement are what? Are generated from summary of what? Ledger. And as you can see, even what? You can see the fifth one, which is what? Financial statement. Before I can prepare financial statement, once my ledger is what? My ledger is correct, I will just put it in the trial balance. Under trial balance, there is no any calculation. It's just for us to divide. It's just for us to divide the item into what? Into two. Trial balance will have twofold. We are going to have a column for debits, and we also have for what? For credits. So all our assets and expenses, please don't forget, all assets and expenses is going to have what? Is going to have a debit balance. So meaning that what? In the trial balance now, our asset and expenses, you are going to find it in the what? You are going to find it in the debit side. Asset and what? Expenses is going to be in what side in the trial balance? It's going to be in the what? Is going to be in the debit side in the trial balance. So while the remaining three, which is our liability, our income, and our what? Equity, is going to be in the what? In the credit side of what? Trial balance. So if our what? If our ledger is what? If our ledger is correct, then our trial balance will also what? Our trial balance is going to be what? Our trial balance will also correct. Once our ledger is correct, our trial balance will also what? It will also be fine. And don't worry, we are still going to talk about the situation whereby the trial balance will not agree. Then what are we going to do next? So this is what we also talk about what? Accounting what? Accounting equation. Accounting equation. Asset equals to what? Liability plus what? Equity. Accounting, this is what? Accounting equation. Accounting equation is what? Asset equals to what? Liability plus what? Plus equity. That is your asset now. If you want to asset now is made up of what? Two components as well. You can have what? Two type of what? Assets. We can cut in our what? In financial statement, asset can be categorized into two. We have what we call current assets, and we also have what we call what? Non-current assets. Asset can be categorized into two in our financial statement. We have what we call current assets, and we also have what we call what? Non-current assets. And when we say what? Non-current asset, in the olden name that maybe some of us will know before in our elementary studies, we call it what? We call it fixed asset. We call it what? Fixed asset, but we don't call it fixed asset anymore. We call it what? Non-current asset. And when we say non-current assets are those assets that will last for what? For more than one accounting period. Those assets that will last for more than one accounting period are what we call what? Non-current assets. Like your motor vehicles, some of your plant and machinery that you have in your in your companies. So those fixed assets in nature. So those assets that's going to last for more than one accounting period are what we call what? Non-current asset. Then we also have what? We also have what we call what? Current asset. Current asset are those assets that we are expected to realize them within a what? Within a 1 year. Within a 1 year. Like if you have a receivable now, Your customer is what is owing you certain amount of money. So, but we expect the customer to pay within what, within a 12 months. So we are going to categorize it under what? Under current asset. Then we also have what? Liability. Liability can also be divided into two. We can also have two types of what? Liability. We have what we call current liability, and we can also have what we call what? Non-current liability. Current liability are those liabilities that the organization is expected to settle between what? Between 1 year, between a year, just like you have current. So if you are also owing your supplier, they have supplied you a certain goods, but you have yet to make the what? You are yet to make the payment. Then, so if the payment term is expected to take place between the next 12 months, so we are going to categorize it under what? Current liability. But those liabilities that are what? We are not paying them in the next 1 year, we call it what? Non-current liability. For example, now if you take a loan from the financial institution and the due date is what? Let's say 2 years time or 3 years time. So in our financial statement, that the principal amount of the loan that we collect from our financial institution, we are going to call it what? Non-current liability. Okay. Then we also have what? Equity. Equity, we have different component of equity. Like in your the capital that you introduce to the business is equity. Some of our profit, our retained earning, they are equity items. Don't worry, when we get to when we are preparing statement as well, you also be understanding some of what's made up of equity. And if you can remember during the last class, we say equity is the residual interest of the owner in the business. So account ledger a ledger account debit and credit. An account is a record of transaction involving a particular item. A ledger account may be through as is a record kept as a page in a book. The book contains many pages, just like I mentioned earlier. That ledger contain we can have different type of ledger. So because each transaction sometimes they are not similar. So and if you want to in accounting, if you want to aggregate something together, it has to be something that have the same characteristics. So if they don't have the same characteristics, then you have to have a separate ledger for them. So, but if they have the same characteristics, okay, you can combine it together. We can do some aggregate if they are similar. But if they are not similar, then we have to make a Like for example, now if we are paying insurance premium now, is different from electricity. So I'm going to have a ledger for electricity. I'm going to have a separate ledger for insurance, because they are not because they are not the same. So if they are not the same, we are not going to have we are not going to combine them together in a single ledger. We are going to have them in different we are going to have them in different ledger. All right. So that is it. So, and every transaction, we are going to have one that we are going to debit, and another one that we are going to credit as well. So what are the steps that you need to take? What are the steps that you need to take when you want to record a transaction? First of all, you need to identify the items that are affected. You need to identify You need to identify the items that are affected. Items that are affected based on the classification. You see, is it affecting our asset? Is it affecting liability? Is it affecting equity, liability, or expenses? The 5 elements of financial statement. So you need to first of all identify them. Then the next thing that you need to do is consider whether they are increased or decreased. Consider whether there's consider whether they are increasing or they are doing or is decreasing. The first thing you need to do is just like you are doing you are doing classification. You are classifying you are classifying the item, the transaction that occurred. Oh, this transaction that occurred now, is it asset based? Is it liability? Is it relating to equity, expenses, or income? That's the first thing that you need to identify. Then the next thing that you need to do is to consider that, if, for example, now in the first one is relating to asset. then I have to what? I have to ask myself now that, oh, is it what? I have to ask myself now that, is it increasing or what? Or is it decreasing? That's another thing that you need to consider first. Is it increase or what? Or decrease? So let's say, for example, now assets or expenses, like I told you earlier, that they have the same treatment, they are increasing. That means that you need to what? You need to debit. That means that you need to do what? You need to debit. If they are what? Reducing, that means that you need to what? You need to credit. If it is your what? Your liability, your income, or your equity, if they are increasing, what you need to do is to what? You need to credit. All right. Why? If they are what? If they are reducing, you do what? You debit. So that's one thing. The next thing you have to consider. Then the third one is that decide whether each account should be debited or credited. So once you identify that, oh, this particular one is what? Is asset, Abby. Then is it increasing or decreasing? Then you have to be thinking of what? Oh, which account will you debit and which one do you need to what? Will you need to credit? Then the last one, check that a debit entry and a credit entry have been made and they are both of the same what? They are both of the same amount. Check that. It is very, very what? It is very, very important. Check that, because if the transaction is what? 1,000 in monetary terms, then that means that what? You need to have some ledger now. There's going to be one place that you debit and there's another one that you're going to do what they are going to credit. So 1,000 must be in debit side in one account and 1,000 must also be in what? In another account. So they have to be what? They have to be equal. 1,000 in the debit side, in the credit side as well, there has to be what? 1,000. Okay. So what is bookkeeping? What is bookkeeping? What do we mean by double entry bookkeeping? Bookkeeping is a what? Bookkeeping is a technique of recording financial transactions. If I say this is this is a bookkeeper, that means that is a what? Is someone that is recording what? Financial transaction. Bookkeeping is a technique of recording what? Of recording financial transaction as they what? As they occur, so that some summary may be made of the transaction and presented as a report to users of what? To users of account. Double entry bookkeeping applies to the recording of transaction in what? In a ledger. That's a simple thing. That's what we are talking about. When we say double entry bookkeeping is about what? Recording what? Transaction in what? In ledger. So the process of recording transaction, the process of recording financial transaction in a ledger is what we call bookkeeping. It's as simple as that. The process of what? The process of recording what? Financial transaction. The process of recording financial transaction in a ledger is what we call what? Is what we call bookkeeping. The process of recording financial transaction in a ledger is what we call what? Bookkeeping. So today now we are going to be doing some bookkeeping work. So what are some what do we talk about? What do we talk about? We'll talk about what is the ledger. And please don't forget the main thing that what we are talking about is the words. I think look at this word. Don't forget this process. What are the steps that you need to what? You need to consider when you what? When you want to record what? When you want to record transaction. What are the what? What are the process? What are the things that you need to consider when you want to record transaction? Because we are going to have a ledger. This is a ledger now. You can see to be in three form, you have a debit, you have a credit, you put your unit of measurement. So now if I now want to record a transaction in this ledger now, what are some of the process that I need to take? First of all, identify the items that are affected. Identify the items that are what? Affected. The next thing you also need to do is what? Consider whether they are being increased or decreased. No, I always said this, and I'm still saying it again. Don't forget, we can every item in the world, every item as every financial transaction can be categorized into 5. There are some transactions that are what? Assets, expenses, liability, equity, or what? Or income. So you have to decide that, oh, is the asset increasing? Is it what? Is it decreasing as well? So you have to, another thing that you also need to do is what? Oh, identify the account that you're going to debit, identify the what? The one that you are going to what? Credit as well, and make sure that there's the what? They are the same amount. If you record what? 1,000 in debit side Then in the credit side as well, you must also have the same one. You must also have the same amount as well. So now let's play with some of this things now. And this is a question one. Now, what's the requirement of the question? The requirement says that use the word accounting equation to illustrate the position of the entity at the end of the day. Use the accounting equation to what? Use the accounting equation to illustrate the position of the entity. And what is the accounting equation? Accounting equation is what? Asset equal to what? Liability plus equity. That is asset equal to what? Equity plus what? Plus liability. That is what? That is accounting what? That is accounting equation. So these are transactions that occur in different days. Now we have 5 days now. Day 1 to what? Day 1 to 5. So we are going to use accounting what? We are going to use accounting and we are going to use accounting distance. We are going to use accounting information to do what? To present the position of the entity at the end of what? At the end of this day. Okay? So let me watch. Please hold on. Please hold on. Let me share my. So these are transactions that occur now. So now we see what the transaction of the new business entity in its 5 words. That is, this is a new business. So these are transactions that occur within the 5 days. Day 1, AVO commence a business and introduce 1,000 naira cash. It commence a business and introduce introduce 1,000 as what? As cash. So now, first of all, you need to you need to pick what? For example, now, in this particular transaction, that means that I introduce 1,000 naira cash. And you know that cash now is cash is asset. So if you are introducing a money to the business now, and don't forget, in accounting, we have what we call entity concept. And what the entity concept is saying is that the owner of the business is different from the business himself. So if you have Mr. James now, Mr. James is different from James Limited. Mr. James is different from what? Mr. James is different from what? From James Limited. Mr. James is different from what? Is different from James Limited. So there's a separate entity between the owner and the business. So is introducing what? Is introducing a cash now, and cash is what? Is assets. So that means that we have what? We have asset of what? 1,000 naira now. So we say what now? Accounting what? Hold on. Sorry, I'm going to try to get my macro working properly. So now, no, we say that what now? That assets, that is accounting equation, are equal to assets equal to what? Equity plus what? plus liability. That is what, that is the accounting equation. So in the what, in the first day now, you introduce a what, you introduce a cash of what, 1,000 naira. So that means that you have a what now, cash now is a what, cash now is what, it is asset to you. So that means that your what now, your asset is what now, you have asset now of what, of 1,000 naira. And I told you as well that what, the owner, AVO now, commence business now, introducing a what, 1,000 naira cash. So it's like what now, there's a separate legal entity between AVO and the business. So that means that what the owner of the business is contributing will serve as what, equity. We call it what, capital. Or you cannot ask, don't worry, from nowadays we hearing about what, capital. But when you heard about capital, just have it at the back of your mind that is a component of what, is a component of equity. So that means that you have what, you also have 1,000 naira as well. And we did not have what, we did not have any liability at the what, at the day one. So you have assets, which is what, the assets that you have now, a cash now to the business, it is what, assets. And your what, the money that you're also introducing to the business is what we call equity. Is what is capital, right? But is a component, capital is a component of what, of equity. So there's a difference between what Mr. James and what James Limited. So if Mr. James is introducing a what, a 1,000 naira to the what, to the business now, it is what, it have to fold. That means that they have asset and they also have what, equity, which is what, capital now. So you can see now that both the two are what, at the same thing. We have one asset of what, 1,000 naira, and we also have equity of what, 1,000 naira. That is what, that is the under what, accounting equation for this what, for this particular what, day one now. AVO commence a business introducing a what, a cash of what, 1,000 naira. You introduce a cash of what, a cash of 1,000 naira. So that means that you have cash now is a what, asset. Then what you are introducing is the what, is the equity to the what, to the business, because the business also has to pay on, they have to pay back one day to the what, to the owner. So that is for what, that is for the day one. So now what happened in what, in day two now as well? In what, in day two now, you can see bought a what, a motor car for what, 400. Bought a what, a motor car for what, for 400 cars. Then you need to ask yourself now, what is what? What is motor car? What is what? What is motor car? Motor car to the business, it is what? It is asset. It is what? It is asset. So motor car to the what? Motor car to the business now, it is what? Motor car to the business, it is what? It is asset of the what? It is asset of the business. So the motor car now is what? The motor car, it is what? It is asset. And how much do you buy this motor car? Is that the worth of what? It is 400. It is what now? It is what? 400. So that means that the entity what? But you have to look at two things now. You know, how much did I have before? I have what? I have 1,000 naira. The only assets that we have before, it is what? It is the cash position that we have, which is what? 1,000 naira. But in day two now, we bought a what? A motor car for what? For 400. So what now happened now is that, let me now show you what happened. You see now, you know, before, let's say what? In day one now, day one, we have what? Our asset is what? Is 1,000 naira. And our what? We also have equity of what? 1,000 naira. There's no what? There's no liability. That is in what? In day one. But in what? In day two now. In day two now, we can see now that this motor car now, this motor car, it is what? It is asset. So that means that what? It is asset. But you know, I am what? I am paying for it. I am paying for it. So now let me now what? Let me classify this for you now so that you understand it better. Let me go back. Let me clean this. So in what? In day two now. in what? In day 2. You know, before, let me all the asset now. Let me call all the asset out. Let me write it out. In day 1 now, you have 1, which is what? Cash. That's the only assets that you have, which is how much? It's 1,000 naira. In day 2 now, you have another asset, which is what? Which is motor what? Which is motor car. And motor car is how much now? What is the price of the motor car? The motor car is what? The motor car is 400 naira. But mind you, you are paying for it. Let's say you bought a what? You bought a motor car of how much? You bought a motor car of 400 naira and you paid in what? And you paid in cash. You can see it is clearly stated. A motor car, bought a motor car for what? For 400 naira cash. So that means that what? The means of payment now is that what? You pay what? You pay 400 naira. So that means that your cash position now, your cash position is reducing by how much? Is reducing by 400. So that means that you have what? Your cash position will not be what? 600 naira now. So then you have what? You have your motor car of what? 400. So at the end of the day, your asset is still what? Your asset is still 1,000 naira. So that means that your what? Your cash is what? Is reducing. At the end of day 1 now, you have assets. And what is the component of this asset? Is your what? Is your cash. So that means that you have the cash of what? How much now? 1,000 naira at the end of what? Day 1. Let's say Monday now. On Tuesday now, let's say that's the what? That's the day 2. You now bought what? You bought a motor car for what? For 400, and you pay by what? You pay by cash. You pay by what? You pay by card. So that means that your cash is reducing to what? Your cash is reducing by 400. So that means that at the end of day 1 now, your cash position is what? Your cash position is 600 naira. So why your what? Your motor vehicle is 400. So that means that at the end of day 2 now, you can see your asset, the total of your asset is still what? Is still 1,000 what? 1,000 naira. So that means that your what? You see at the end of what? Day 2 now, you are still going to have what? You are still going to have the same amount as what? As asset and what? And liability as well. So that means that your what? In day 2 now, in day 2, you are still going to have asset of 1,000 naira and equal to what? Your equity, nothing what? Nothing changed. So 1,000 naira, 1,000 naira. That is based on our what? Based on our accounting what? Based on our accounting equation. It is what? 1,000 naira and what? 1,000 naira. Okay. So that's what? That's what occurred in what? In day 2. So let me write it very well for clarity purpose. So in what? In day 2 now. In day 2, we say accounting equation equal to what? Accounting equation equal to asset. Asset equal to what? Equity plus what? Plus liability. Under your what? Under your asset now, that means that you have 2 components. You have a cash. The cash that you have before is what? Is 1,000 naira, Abi? And you paid what? You paid 400 naira out. So that means that you have cash position of what? Of 600. Then the 400 naira that you paid out is for you to buy what? A motor car, which is what? 400. So at the end of the day, you have what? 400. So that means that your total asset now is still what? Is still 1,000 naira. So why your what? Your equity does not what? Your equity does not change. So your equity still remain what you have in the what you have in the day 1, which is what? 1,000 naira. So we still have what? 0 liability. So our asset is what? 1,000 naira, and our equity is also what? 1,000 naira as well. That is at the end of the what? The day 2. Asset must be equal to what? Equity. What must be equal? Equity and liability must equal our what? Must equal our asset. Equity and liability must what? Equal our asset. So what happened in what? What happened in the what? In the day 3 as well, based on the accounting equation. What happened in the what? In the day 3? They say obtain a what? A loan. Obtain a 1,000 naira what? 1,000 naira, $1,000 what? $1,000 what? Loan. You obtain a loan of how much? You obtain a loan of 1,000 what? You obtain a loan of 1,000 naira. You obtain a loan of what 1,000 naira. So now let's now put something that what happened in what in day 3 now, that you obtain a what a loan of what you obtain a loan of what 1,000 naira. So now in what in day 3 now. So now you can recall in what at the end of what at the end of day 2, you have what now at the end of day 2, your asset is what 1,000 naira, and it is also equal to your what equity and liability of what 1,000 naira. So in what in day 3 now, you now obtain a what you obtain a loan of how much? You obtain a loan of $1,000 from your what from your bank. So now you know if bank want to pay you now, if you go to the bank now and you obtain a loan, what are they going to do? They are going to transfer the money to your what to your bank. What they are going to transfer the money to your bank account. So that means that your asset is what is increasing now. So that means that in day 3 now, our asset now. Let me break it down for you. We have what? No, we have cash initially of what 1,000 naira, and we procure what we bought a motor car of what bought a motor car of 400. So that means that we have what 600 naira. Then we have a motor car of how much at the end of the day of what 400. So now we now have a what? We now have a bank now. We have a bank. We have money in our bank account, which is as a result of the what the loan that we have, which is how much now, which is what $1,000. So at the end of the day, our total asset will now be what 2,000 naira now. So, and if you can recall, in what this is only what equity. We have a zero what we have a zero liability. This is only equity. We have zero what we have zero liability. So our equity, our liability will now, because the money that you borrow from the bank is a liability. You are still going to what? You are still going to pay back. It depends on the what? It depends on the terms between you and your and your banker, and which we are not interested in. What we are not interested in that as of now. Okay, so that means that what you have you have a liability, because you need to what? You need to settle the what? You need to settle the bank as well. So that means that you have equity before of how much? You have equity before of 1,000 naira, and the loan that you have now is a what? Is a liability. The loan that you have now is a what? Is a liability of what? 1,000 naira as well. So you can see the addition of the word equity and the liability now is what? Is 2,000 naira. So that means that what we have the same we have the same amount as well. To 2,000 naira. All right. So that is the accounting equation of it. So let me explain one more. You can see the breakdown of our assets. In the day 1, we introduce a cash of what? 1,000 naira, and in the day 2, out of the 1,000 naira that we have, we bought a what? We bought a motor car for 400. So that means that our cash balance now is showing what? 600 naira, and we have a motor car, and the motor car is what? It is asset to the to the company by what? By 400. And we also have a bank loan. A bank loan, that's what occurred in the day 3. In the day 3 now, you obtain a $1,000 loan from the bank. So the bank now, they will pay to your bank account. So that means that your bank account is increasing, and your bank is the bank is is asset to is asset to the business as well. So your liability will also your liability will also increase as well, because you need to pay back the loan. So that means at the end of day 1 now, our assets equal to what? We have asset of what? We say accounting equation equal to assets plus what? Equity plus what? Plus liability. So that means our asset of what? 2,000 naira. Then our liability is also what? Is also 2,000 naira, which is made up of what? 1,000 naira equity plus what? Plus 1,000 naira liability, which is the what? Which is the loan. Which is the what? Which is the loan. All right. So that is it. So we also have what? We also have day 4. What happened in what? What happened in day 4 as well? Day 4, purchase goods for what? For 300 what? For 300 cash. Purchase goods for what? For 300 what? For 300 cash. Purchase what? Purchase goods for $300 what? Cash. And when we say what? Purchase represents a cost. Because we are buying something and it's like what? It's like expenses. It's like what? It's like expenses. So purchase represents a what? A cost to the entity. Is what? It is expenses. Purchase is what? It is expenses to the entity. And these expenses will reduce the what? Will reduce the profit of the entity. Which will what? Which in turn reduce our what? Which in turn reduce our equity. If you can remember in the last class, we can remember in the last class, we said that what is equity? What is equity? And hold on, let me no, that's not this. Okay, this is let me, if you can remember the definition of the definition of equity. This is the definition of of equity or expenses as well. These are the definition of the three elements in the financial statement. You can see when we say expenses is what? Decrease in what? Don't forget it. Decrease in assets or increase in what? Increase in liability. That results in what? Decrease in what? In equity. Decrease in what? Decrease in assets or increase in what? Increase in liability. That results in what? Decrease in what? In equity. So you can see the definition of what expenses now. We say it is what? Decrease. It's going to decrease your what? It's going to decrease your assets or decrease in what? Decrease in liability. That results in what? Decrease in equity. So that means that our equity is going to do what now? Our equity is going to drop. Don't forget this definition. Don't forget them. Why the opposite is the what? Is the income. So expenses now is what? Increase in what? In assets. Increase in what? Decrease in what? Decrease in asset. That is expensive. Decrease in asset. That means that your asset what would decrease, or your liability will what? Your liability will go up. That results in decrease in what? You can see the end product now. That means that we have two things. Either your asset is going to what? Decrease, or your liability will what? Will increase. Your liability is only going to increase if you what? If you did not make the payment now. Your liability will increase if you did not make the what? If you did not make the payment now. That is when your liability will increase. And your what? Your asset will decrease if we make the payment now. And in this situation, the organization make the payment now because they made the payment cash. We are not told that it is what? It is on credit. So that means that our asset will do what now? Our asset will drop. Our liability will still remain the same thing. Our liability will only increase if we did not pay. I purchased the goods from you now. I did not pay. You know I'm owing you. So that means that my liability will what? My liability will increase. But now we paid by what? We paid by cash. So that means our cash is what? Cash is what? Cash is our asset. So that means our asset is what? Is reducing. Our asset is reducing, and you can see that what? That results in decreasing what? In equity. That results in decreasing what? That results in decreasing what? In equity. So that is what? That is the definition that you can see. So now let's go back to what? Let's go back to our ledger accounting. Okay, so now let's open our work file. So let me go to the next page. So now in the next, you can see in what happened in day 4. What happened in day 4? What happened in day 4? What's at the end of what? You know, at the end of day 3, our asset is what? Our asset is 2,000 naira. Must also be equal to what? Equity plus what? Plus liability. So now our asset is what now? At the end of what? Day 2. I'm sorry, day 3, it is what? 2,000 naira. And our what? And our equity is what? 1,000 naira. And this is also what? And our liability is also what? 1,000 what? 1,000 naira. Now, in what? In the what? In day 4 now that we are, We are now told that we purchased goods for how much? For 300 naira. And we paid by cash. Since we pay by cash now, so that means that our cash is what? Is reducing. So that means the asset is reducing by what now? By 300. And our equity will also what? Reduce by how much? By the same amount as well. By the same what? By the same amount, which is what? Which is 300 naira as well. Then we have what? 0 here. You know, you can see the definition of what, when we say something is expenses. Expenses what will result in what? Decrease in assets. Expenses are what? Expenses result in what? Decrease in what? In assets, or increase in what? In liability, that result in decrease in what? In equity. The reason why I am bringing this 300 what? This 300 here is because now we pay. You know, what is the definition of what? What is the definition of expenses? Expenses is defined as a what? As a decrease in what? In assets, or increase in what? Liability. Don't forget. Increase in what? Asset. No, sorry. Increase in what? Increase in liability, or decrease in assets. Decrease in what? Decrease in assets. That means that our asset is going to decrease. Why is our asset decreasing? Because we made the payment now. Or increase in what? Or increase in liability. Our liability is going to increase if we did not what? Assuming that we did not make the payment now. But in this situation now, the payment was now. That means that we pay by what? We pay by cash. That will result in decrease in what? That will result in decrease in equity. So that means our equity now is what? 700 naira. Our what? Our liability still remain what? Still remain the same, 1,000 naira. So 17 minus what? 300, we have what? 700 naira. So that is what happened in what? That is what happened in the day 1. Sorry, in the day 4. But when we say expenses, don't forget expenses. What? Expenses result in what? In decrease in what? Decrease in asset, or increase in what? In liability, that result in what? That result in decrease in what? In equity. So purchase now is what? Purchase is what? It's kind of expensive. All right. So at the end of the what? At the end of the day now, what? Our asset and liability, you can see they are both what? They are both the same. So now what happened in the words in the day 5, which is what? Which is the final day. Sold goods for what? For 400 on credit. Sold goods on 400 on credit. So when you sell is a what? When you sell, it is what? It is an income. When you sell is what? It is income. It is what? It is income. And what is the definition of what? What is the definition of income? You can see the definition of income. Income increase in what? Income results in increase in what? Increase in assets. Or decrease in what? Or decrease in liability. That results in increase in what? In equity. Look at the definition. Sales is a what? Because if you sell now, something is coming in. So your asset what? Your asset what? Your asset will increase. Or your liability what? Will drop. That will result in increase in what? In equity. So you can see the difference between what? Income and what? And expenses now. Income will result in what? Increase in asset, or decrease in what? In liability. That will result in increase in what? In equity. So now your what? Your sales now. Sales is what? Is example of what? Of income. All right. Now you sell it on what? On credit. So that means that the customer has not what? The customer has not what? The customer has not paid. The customer has not what? The customer has not paid. So if the customer has not paid now, and we are going to make, that is what we call what? Receivable. Receivable are those that is owing the what? Receivable are those that is owing the organization. So in what? In day 5 now, which is the what? In the final day. So at the end of what? At the end of day what now? At the end of day 4, you can see our asset equal to what? Equity. Equity plus what? Equity plus liability. So our asset is what? 1,700. Our equity is what? 700. And our liability is what? 1,000. Yeah. Now, in what? In day 5 now, we are told that what we sell goods on what? On credit. So that means that we are going to have what we call receivable, and receivable is asset. Those people, those customers that is owing the organization, we categorize them as what? Their asset, because they will eventually what? They will eventually pay one day. So that means that what? Our asset is increasing. Then equity will also what? Equity will also increase as well. Then our liability is what? Is 0. So at the end of the day, we have what now? We have 2,100. So our what again? Our equity has turned back to what? Our equity has turned back to 1,100 naira. Then our liability still remain what? Still remain 1,000 naira. So you can see that they both what? You can see that they both agree. You can see now that they both what? They both agree. They both what? They both agree. They both what? They both agree. So that is the accounting equation for this particular what? For this particular transaction. Okay. And please don't forget, when we say accounting, what we just need to do is, first of all, what you need to try as much as possible to what? To identify the item. That is what actually happened. Is it relating to what? Is it relating to assets? Is it relating to what? To liability? Is it relating to what? To income? Is it relating to what? To expenses? Or is it relating to what? To equity? So these are the 5 what? These are the 5 elements of what? Of financial what? Of financial statement. And I told you that, you see, as asset, your asset is what? If your asset is increasing, you do what? You debit. That's what? Increase. If they are what? If they are reducing, what are you going to do? You are going to what? You credit. Asset and what? Expenses, they have what? They have the same treatment. It's about what? Debit this as well. If it is increasing, if it is reducing, what will you do? You what? You credit as well. So your what? Your liability. If your liability is what? If your liability is increasing, now what are you going to do? You credit. So if it is reducing, you do what? You debit. Your income as well, if it is increasing, you do what? You credit. If it is reducing, you also do what? You debit. Your equity as well, increase, you debit, and decrease, you do what? So that is it. So both what? Both our what? You can see asset and what? Asset and expenses, they have what? They have the same treatment. So liability, this and this as well, they have the same what? They have the same treatment as well. They have the same treatment as well. Okay. So let's go. This is what accounting what? Equation. And so let's now go to the next one, which is about what? Which is about the ledger, which is one of the most important things for today. So you can see in what's in question 2, we say increase in asset. What are you going to do? If your asset is what? If your asset is increasing, what will you do? If your asset is increasing, like I mentioned earlier, you're going to do what? Increase in asset is debit. Increase in asset is what? Increase in what? Increase in asset is what? Is for you to debit. Increase in asset, debit. If your what? Increase in liability. If your increase in liability is going to do what? Increase in liability, you also do what? You credit. Increase in income, credit. Decrease in liability, debit. At least you have what? You have all of them in this particular what? This particular page now. If your what? If your asset is what? If your asset is increasing, Your asset is increasing, what are you going to do? If they are what? If they are decreasing as well, what are you going to do? So these are the what? Your asset is increasing, you do what? You debit. If it's reducing, you credit. If your liability is increasing, you do what? You credit it. If it is what? Reducing, you debit. If your income is what? If your income is increasing, you do what? You credit, and you also do what? You debit. If your expenses is what? If your expenses is increasing, debit. If it's reducing, credit. Equity increase, credit, and what? Decreasing, you do what? Debit as well. So let's now what? Let's now go into what? Let's now go to the what? To the next question now, which is to what about what? This is about ledger. So we have this question now. They say what? BL started a business on what? On May 1. And during the what? During the first month, we entered into the what? Into the following what? Into the following transaction. Into the what? Into the following transaction. Into the what? Into the following transaction. On the 1st of what? May, BL started a business as a what? As a sole proprietor with $20,000 in what? In cash. In what? In cash. So that's like the what? That's what is used to start this what? Use it to start this business. Use it to start the business of what? 2,000 what? 20,000 cash. Okay. The next day, pay what? That's 2nd of May. Pay 15,000 cash into the what? Into the business bank account. And on the what? We also have May 4. Purchase goods on credit from JM for how much? For 2,000 what? 2,000 naira. I'll be sorry, $2,000 as well. So now look at what? Look at this. Each of this. Look at this. Each of these transactions for some few words, some few seconds now. So now, if I would so now let's now what this is relating to what now? This is relating to question 3. So you can see. So the first transaction, and I have one was BL started a business as a sole proprietor with how much now? With 20,000 naira. And just like that we have before, that's the word, that's like a capital now. So I'm going to have what now? I'm going to have a ledger now. So this is a ledger now, for example. I have my the heading of it will be for the I'll have a capital, have the credit side, and also have the debit side as well. So you also need to you need to include the unit of unit of measurement. So now you can see on 1st of May now, we have a capital. So that's the first thing that you need to do. If you check this particular slide now, let's take you back here. You can see step to record a transaction. So the first thing that you need to do now is for you to identify the item. Identify the item. And identify the item that occur. That this particular transaction is relating to is relating to capital. Is relating to capital. So that means that what is increasing now? And you can see now, if your capital is increasing, what will you do? So if your capital is increasing, what are you going to do? You are going to credit. You can see increase in equity, because capital is a component of what? Capital is a component of equity. So I'm going to do what now? I'm going to credit that particular ledger. All right. So and you're introducing what? You're introducing $20,000. So that would be what you just need to do, just to write the date as well. So that's what 1st of May. Then you have your you have a 20,000 you have your 20,000. So now, boy, you need to ask yourself now that, okay, you introduce a capital of 20. You have credited this account now. So the duality concept will have to come in now, which is by once I credit this now, then I have to do this a corresponding entry now to another ledger account. So you just have to look at the question back and go back. So now you started a business and you have a cash. So that means that you introduce a cash. So that means I'm going to have another ledger now for cash accounts. And since I've credited one ledger, so that means that the next thing that you just do now just to debit this. Because I can't credit one account and I also do another thing again. So if you credit one, you also do you also debit another one. So I can just now? I can leave this particular page now to maintain the capital, while you can just go to the next page and have a ledger for cash accounts. So now just say May 1, you have you have 20,000 naira. $20,000. And you also, these are credit and this is my all right. That for the fourth transaction. They started a business with the 20,000. And so every transaction that you can see, they will have twofold. Meaning that there's every transaction here now, I'm going to debit one and I'll also credit I'll also credit another one. All right. So that's for the first one. So if it is introducing the capital, the first thing is just credit capital account and debit the cash. So you can see in the next date now, I paid say maybe that's on 2nd of May, you paid $15,000 cash into the business account. So that means that there's another money coming in on the 2nd of May, which is to pay which is to pay 15,000 what? 15,000 cash into the what? Into the business bank account. All right. So that means that for this particular transaction, the next thing that you have to ask yourself now is that, okay, which account am I going to credit and which one am I going to what? Am I going to debit? So if what? He paid 15,000 cash into the what? Into the bank. So that means that the what? The money is now is going out of what? Cash account. And it's going to the what? It's going to the bank. So that means that, for example, now I have to do what now? I have to credit the what? I have to credit the, I have to credit the cash account, because cash account now is a what? Is like asset account. So if you have what, you know, before you have what, 20,000 naira in your what, 20,000 in your cash account. So, and 15,000 naira is what is going out now. So we have to ask ourselves now that, okay, is it increasing or what, or decreasing? And you can see now is our cash is going to what is going to reduce. So I will just write now on what, on 2nd of what, 2nd of May, which is what, 15,000 naira is what is going out. Then let me have another page to maintain my what, to maintain the bank account. So this bank now. So have our what, our debit and our what, and our credit. So you can see now on May 1, I have a what is coming from cash, right? Of what, 15,000. So that is that for the what, for the second what, for the second transaction, which is to what, he paid 15,000 cash into the business bank account. So that means that the money is going out of what, the money is going out of cash and it's going to the what, it's going to the bank. And you can see now this particular transaction, it is what, it is asset, just that you are just transferring from what, from one ledger to what, to another. It's not as if we are bought, we are buying anything. All right. So since I'm what, we have 15,000 naira cash into the what, into the business account. So that means that the money is going out of cash, then it's going to the bank. So credit the what, credit the cash account, and debit the what, debit the bank account. So on the what, on the next day now, they say what, May 4, purchase goods on what, on credit from JM for how much? For 2,000 naira. And you know that purchase now, purchase is the what? Purchase is expenses. Purchase is what? Purchase is expenses. So what I'm going to do now is to what? Since it's on credit, so that means that there's a liability now. So that means that the suppliers now, the business is yet to what? The business is yet to pay. So those that the business is owing now, you know, we call them what? Trade payable. So now, so that means that, for example, now I need to maintain a what? I need to maintain a ledger for what? I need to maintain a ledger for this transaction as well. So that means that, for example, I have to have what? I have to have a trade what? Trade payable what? Trade payable account. Then I also need to have what? I also need to have a purchase what? I also need to have a purchase account. Debit and also have what? So now, since what? If you look at this page now, look at this particular page. Liability now, that's what we are talking about. If your liability is increasing, you do what? You credit. If it is reducing, you are going to do what? You debit. You know, for example, now, we now need to ask ourselves now, I purchased something from someone which is worth what, 2,000 naira, and I have not paid. Is my liability increasing now, or is it what, reducing? So you can see now that liability is what, is increasing because you have not what, you have not paid. So that means that, for example, now we need to debit the what? We need to credit the liability account. So if your liability is what, is increasing now, what are you going to do? You are going to credit it. If it is increasing, you are going to do what? You are going to credit. But if it is reducing, maybe in the later long run, you have paid. So that means I have to debit that particular what? I have to debit that particular account. So what are we going to do now for the what? For this particular transaction? And since we have what? We have a trade what? And those that the organization is owing, we call them what? Payable. Those that those individuals that what? That's owing the organization, we call it what? Receivable. Okay. So we need to look about what is the monetary impact now. It is what? May 4, purchase goods on credit for what? From JM for how much? For 2,000 what? For 2,000 naira. So that means that what on what May 1. So I have to have May. Yeah, 2,000. Do your credit and you also do your what? And that is for what? That is for this transaction. So you have debit one account, then the next account that you need to do now is for us to have a what? A purchase what? So also have a purchase account. So we have May 4, write the date, just write the name of the supplier. That's how much? 2,000 naira. So you can see you debit one and you also do what? You credit another account as well. You can see I've debit this and I've also credit what? No, sorry, credit this and you also do what? You debit this as well. All right. So in the next day now, which is what? May 6th, purchase goods from ERD on credit. So that means that you also purchase goods on what? On credit from what? ERD. For how much? For $3,000. So you pay on the 6th of May, purchase goods from what? ARD on what? On credit. You know you have not paid. That's the liability now. So that means that your liability is what? Is increasing. And if your liability is increasing, what are you going to do? You are going to credit. If your liability is what? Is increasing, you do what? You credit. So there's no need of drawing up a new ledger for this particular one. It's what we have before that we are still going to use. So that means that on what? On the 6th now, 6 May, ERD. And sorry, what is the what? What's the amount? Let's go back and check it. The amount is what? The amount is 3,000 what? 3,000 there, $3,000 as well. So that means that I will do what now? I have to write what? 3,000 here. Then we now go to what? We are going to go to our purchase what? Purchase account and say what? 6 what? May what? ERD is how much? Is 3,000 what? 3,000 there. $3,000 as well. So put the what? You also need to maintain the what? The unit of measurement. It is whatever the currency that the examiner has used. So we just need to what? Just need to follow it. So that is for what? That is for that. Then the what? The next transaction now is what? It is on the what? On the 7th, May 7. Pay wages in cash for how much? You paid wages in cash for what? For 60. You paid wages in cash for $60. So, and you can see it is true what? Through cash. So that means that you need to ask yourself now that of what? On May 7 now, paid wages in cash for what? 60 what? $60. Is my what? Is my cash account now? Is it increasing or is reducing? So you can see now there's a what? There's a movement. There's an outflow from your cash account. So that means that your cash account is what? Is reducing. And if your cash account is reducing, and so that means that I need to do what now? I need to credit it because it is asset account. So we'll credit what? We are going to credit cash account and we are going to debit what? Debit wages account. Because wages is what? It is expenses. And wages is what? It is expenses. And all expenses will have what balance? All expenses will have a debit balance as well. All right. So we have what? We have cash account already. So let's just what? We just need to go back to the what? To the cash account, which is on the what? On the 7, right? So, but this one is what? It is outflow now. That's what May 7. Just what? Call it what? Wages. Of how much now? Of 60. All right. Sorry, this on the second is supposed to be here because it is what we take it out of what as May. It's going to the what? It's going to the bank. So I need to have what? 15 what? 15,000 there. Then let me clean this. So what we just need to have here is the what is the capital that we what is the capital that we introduce, which is what we introduce a capital on what on May 1. So that's like what capital now, which is 20. All right. So and you can see if we look at what the capital account will be what it will be credited. So you can see capital account is what is credited to, and it's going to the what? It's going to go to the what? It's going to go to the cash account. Okay. Oh, sorry, I've maintained cash account before as well. Sorry. This cash. Okay. Capital cash bank. Okay. Oh, sorry, I supposed to no, sorry, there's a mistake here. So the bank. So, and these wages as well, so because we made the payment by what? Sorry, the bank account. This is what this is not correct. Okay. So I think the only item that we have in the bank, first of all, is the cash, which is that was transferred on the 2nd. You can see on 2nd of May paid 15,000 cash into the business account. Paid 15,000 cash into the business account. So that means that the money is going out of cash account as coming to the bank account. So now, so that would be what now? So that would be on the what? That would be on the 2nd of what? So just like what? You can just say cash, and it is how much? It is 15,000. So if we check the credit side in the cash account now, you're going to see you're going to see 15, which is, you can see it as well. You have 20,000 before, which is the capital that you introduce on the 1st of May. Then on the 2nd, you transfer 15,000 to your bank. So you credit this and you debit the bank. Okay, so where are we? I think we are on the 7th now. You can see now on the 7th, I say paid wages for how much? Paid wages in cash. So that means that you paid wages in cash for how much? For 60. So that means that the money is still going out of what? The money is going out of our cash It's going out of our cash account. So I need to go to cash account and say what? On the 7th. 7 of what? This one will be bank. And this one will be what? Wages. We paid wages of 60. So I need to have another I need to have another ledger now for what? I need to have another ledger for wages wages account, because they are not they are not related. So you need to have another ledger for wages. So do your credit, sorry, debit, and you also do your credit as well. So since you have credit the cash, then you debit this one. So that means that May 7 now, I will now have it's coming from a cash account, right? And you write you write your 60. Every ledger, put the unit of measurement as well. So that is for that particular transaction, which is on the 7th, paid wages is paid wages in cash 60. Then we also have on the 10 now. On the 10, I paid rent by a check of 80. He paid rent for He paid rent of amount of $80. So, and you can see that the payment or what the payment is through what is through the check. And once you hit check now, so that means that we are relating to the what to the bank. So that means that the money is going out of bank, then it's going to what to rent account. So that means that we are going to do what now? So we need to ask ourselves now that is our what bank account increasing now, or is it what is it reducing? You can see now our what. This is our cash. There's our bank account. Okay, we have this is our bank account as well. So bank account now we are going to have on the what 10 of what 10 of May, which is for what, which is for rent, and it is what it is 80. Then you know you have a rent now. Then you have to create another what you have to create another ledger for what for rent. So let me maintain this one to be what to be rent account now. So my debit and my what and my credit. So I'm now going to say what on the 10, right? 10 May. So and the true what is in the what in the bank, right? So you write your what you write your ATS, a bank. So that is for what? That is for rent account. Look at the word, look at the word. You know, it is clearly what? It is clearly stated that you would pay what? Pay the rent by check. And once we head check now, it's through the bank. So that means that, so since we are making a payment now, you need to ask yourself, is my bank account reducing or is it what? Or is it increasing? So like now, your bank account is going to reduce because we are making a payment out of your what? Out of your bank. So that means that bank is what? Is reducing. And what? And if your bank is a what is an asset account, right? So if your asset account is reducing, what are you going to do? You are going to credit it. So you credit the bank with how much now? With 80. And on the next day, look at this. They say what? Pay what? On the 12th, may sell goods for cash. So now we sell goods for what? For cash now. Of how much? Of 210. Sell goods for what? For cash of what? Of 210. So that means that we are going to have another ledger. Let's maintain it here to what? You can call it sales account. So the debit and your what? And your credit. So you made a what now? You made a what? You made a sales. And how do you what? How do you make the sales? You can see the sales is by what? Is by cash. So that means that our cash account is doing what now? Our cash account is going to what? Is going to increase. Our cash account is going to what? Our cash account is going to increase. So on, and it is on what day? That is on the 12th. 12th of May. So we'll call it what? Sales. And which is how much? It is what? It is 210. So these are what? This is the capital that we introduced. So we made it what? A sales of what? 210. So you do now, you can see now that you do what? You debit the what? You debit the cash, and you do what? You are going to credit the what? You credit the sales what? You credit the sales account. So these are what? These are our sales account now. Then you credit your what? Sales account. That is on what? Show of May. Say sales. Then you write the amount 210. Then look at another one as well. Let's say what? Buy what? Buy furniture for what? On that is on what? That is on the 16 now. You buy furniture for how much? You buy furniture for 1,000 what? 500. Paying by check. So this is a furniture. Furniture is what? Furniture, it is asset. And you pay what? You pay 15,000. You pay 15,000 naira by what? By check. So we can see check now is relating to what? To the bank. So since you buy what? You buy a furniture, furniture, it is asset to you now. And how do you make the payment? You make the payment through the what? Through the bank. All right. So that means that we are going to have another ledger now for what? Let me use this particular place. We are going to have another ledger for what? We are going to have another ledger for furniture. For furniture. So now, and how do you make the payment? You make the payment through your what? Through your bank. But you don't have furniture before, so that means that furniture is a what? Is asset. So that means that your asset is what? Is increasing. So write the date, which is on what? Is on the 16th May. And the price is how much? The price is what? 1,000 what? 1,500. And how do you make the payment? You made the payment by what? By check. So that means that the money is going out of your what? Is going out of your bank. So that means that since you debit what? Since you debit furniture what? Since you debit furniture account, so that means that the what? You need to credit what? You need to credit your bank account. So now bank, what are we going to do to what? What are we going to do to bank? We are good. So you just say what? 16 now. 16 of what? Of May. Then you write furniture, which is what? 1,000 what? 1,005. All right. Then what happened again in the next day? We have on the 19th. On the 19th, you what? You sell goods on what? On credit to PSP. On 19th, sell goods on credit to SP for what? For 580. So since you are what? Since you are selling goods now, and it is based on what? And it is on credit. So that means that you have not what? The payment has not yet been what? The payment has not yet been received. And if the payment has not yet been what? If the payment has not yet been received, so that means that is a what? That's a receivable. We call that now a what? A receivable. So that means that what? I'm going on sales, right? By how much now? SP 580. But this one is on what? Is on credit now. So I'm going to have what? We are going to have a new ledger now for what? For those that own the company, and those are what we call what? Trade receivable. Those that is owing the company, we call them what? Trade receivable. So we are going to have another ledger now for what? For that, which is what? Trade receivable. Please don't forget this particular account is for customer that has not what? That has not paid. Customer that has not paid, we are going to maintain a what? We are going to maintain a trade receivable for what? For this is the account that we maintain for customer that has not what? For customer that has not paid. Okay. So for customer that has not paid, we are going to maintain this what? We are going to maintain this account for them. Okay. So that is on what? On the 19th. I say what? Sell goods on credit to what? To what? To P. You sell what? You sell goods on what? On credit. To what? To SP. You sell goods on credit to what? To SP.